Okay, so in this video, I want to go over the interpretation. In the previous video, we discussed how the core essence of auction theory is the core progression as detailed in the Nobel Prize award pages. And that core progression is interpretation forms the market sentiment, which forms the perception of value. And in this video, we're going to discuss the interpretation element, okay? The interpretation is the pivot levels, okay? So let's go ahead and click on this interpretation circle here. Zoom in here. The three elements of this system are the interpretation of market development. Key levels called pivots serve as the interpretation of market developments, the market sentiment, and the perception of value. Value changed my perception of pivots. I used to have a predictive function-based perception of pivots, meaning I perceived pivots as predictive functions, which was support, resistance, and sentiment. This perception made me perceive and use pivots as a function that will predict price direction, which would make me enter the trade when the price hit the pivot, hoping the function would predict price direction, and when the function was wrong, I would lose. Value changed my perception of pivots to an interpretation-based perception. Value made me perceive pivots as levels that serve as the market's interpretation of market developments. This perception made me perceive pivots as interpretations that form the perception of value, which causes the price movement and value on the chart. And that perception of value predicts the continuation of the price movement. This led me to look for all of the different ways pivots on one time frame can form the perception of value, which led me to see all of the different ways pivots on multiple time frames can form the perception of value. This led me to use these pivots of multiple time frames, which can form the perception of value, and incorporate them in my trading, thus allowing me to use pivots as levels that can collectively serve as interpretations that synergistically form the same perception of value. So I changed my approach to waiting for the pivots, the interpretation, to form the perception of value, and for that perception of value to cause the price movement and value on the chart. And then I take the trade so that the perception of value can continue the move. In essence, instead of predicting the move, I follow the move, okay? I look for three compelling indications: interpretation, which are the pivots, market sentiment, and the perception of value, okay? I relate the perception of value found in the short term, which are the H4 pivots or H1 pivots, to the interpretation of market developments in the longer term, which are the monthly pivots or weekly pivots, to see how the longer term interpretation of market development, monthly pivots or weekly pivots, forms shorter term perceptions of value, H4 pivots or H1 pivots. With this, I see the sentiment strength of multiple time frames. Okay. So let's go to the interpretation progression section. Okay. And we already went over this progression in the previous video, but we'll go over it again here briefly. The interpretation forms the market sentiment, which forms the perception of value. The pivots serve as that interpretation. Okay. So the pivots are the interpretation. Okay. Now let's move over to the pivot origins here. And let's start with the pivot points definition. Okay. Pivot points are significant levels chartists can use to determine directional movement and potential support or resistance levels. Pivot points were originally used by floor traders to set key levels. Okay? If you look at this Forbes article here, it says, I first remember hearing about pivot point analysis from the late Manning Stoller in the 1980s. He was the developer of the Stark bands that I frequently used in my analysis. Okay, so Manning Stoller is the developer of pivot points. Okay. Pivot point is a technical indicator formulated by Mr. Manning Stoller in the 1980s, which helps us pick out the whole market trend over different time frames. Okay? So now let's go to this investing.com section here, and let's read how they describe pivot points. Pivot points info. Pivot point support and resistance calculations are widely accepted as the simplest yet most effective trading strategy. They are well trusted by traders, banks, and all financial institutions as clear indicators of the strength or weakness of the market. They are used as the basis for most technical analysis. The pivot point is the point in which the market sentiment changes from bearish to bullish, okay? So this is very important because what this shows us is that the pivots, which serve as the interpretation, are levels that are used by banks and all financial institutions, okay? The financial institutions are the ones that move the markets, okay? So we are relying on the interpretations of financial institutions. Since pivots are used by the financial institutions, that means that we are using the pivots or the interpretations of the financial institutions, meaning the pivots are very powerful interpretations, okay? So now let's go over the pivot point calculations, okay? Pivot points use the prior period's high, low, and close to estimate future support and resistance levels. In this regard, pivot points are predictive or leading indicators, okay? Pivot points were originally used by floor traders to set key levels. Like modern day traders, floor traders dealt in a very fast moving environment with a short-term focus. At the beginning of the trading day, floor traders would look at the previous day's high, low, and close to calculate a pivot point for the current trading day. With this pivot point as the base, further calculations were used to set support 1, support 2, resistance 1, and resistance 2. These levels would then be used to assist their trading throughout the day, okay? And just to see an illustration of these pivots, you can look at this screenshot right here. This is the pivot point, okay? This R1 is resistance 1. This R2 is resistance 2. And they even have calculations for R3, which is resistance 3. Okay? This S1 is support 1. This S2 is support 2. And this S3 is support 3. Okay? So these are what the pivots look like. All right? You can also see here, these are the actual calculations, okay? You have the pivot point calculation, high, low, and close, divided by 3. The support 1 calculation, support 2, resistance 1, resistance 2, okay? You also have the resistance 3 calculations here, okay? Third resistance, third support, okay? Now, there are two ways in which pivot points can be interpreted, okay? And we're going to go over those two different ways in which pivots can be interpreted. All right? One way that the market can interpret pivots is as levels that price can break through, okay? Like a breakout strategy, okay? So the pivot breakout strategy is used in trending markets where price breaks through price levels, signaling a continuation of the trend, okay? When the price breaks above a resistance level, R1, R2, or R3, or below a support level, S1, S2, or S3, traders enter the trade in the direction of the breakout, okay? See here, right here, pivot point breakout, bullish breakout, meaning an upwards breakout. Traders anticipate upward price momentum when the price surpasses a pivot point, typically opening long positions to capitalize on the positive sentiment. To enter a pivot point breakout trade, you should open a position using a stop limit order when the price breaks through a pivot point level. If the breakout is bearish, meaning price is breaking through the level in a downward direction, then you should initiate a short trade, which is a sell trade. If the breakout is bullish, meaning price is breaking through the pivot levels in an upward direction, then the trade should be long, meaning a buy trade, okay? You can see this illustrated here. So in this way that the market interprets pivots, they interpret the pivots as levels that price will break through. So you see price breaking upwards through the R1, then upwards through the R2, okay, all the way up through the R3, okay? So in this way, the market is interpreting the pivot levels as levels that price will break through. Another way that the market interprets these pivot levels is as levels from which the market will bounce, okay? So support and resistance levels based on pivot points can be used like traditional support and resistance levels, okay? The key is to watch price action closely when these levels come into play. If price declines to support and then firm, traders can look for a successful test and bounce off support. It often helps to look for a bullish chart pattern or indicator signaling to confirm an upturn from support, okay? So let me show you this illustration here, okay? So you see price coming down, declining, and you see how it's bouncing up from this S2 pivot, okay? And you also see price dropping and bouncing up from this S1 support pivot, okay? Similarly, if prices advance to resistance and stall, traders can look for a failure at resistance and decline, okay? And this will confirm a downturn from resistance. Let me illustrate that here. So you see price rising and hitting this R2 pivot resistance, and price bouncing down from this R2 pivot. And you also see price rising and hitting this R1 pivot resistance and bouncing down from this R1 pivot, okay? So this will be the middle pivot here. This is the R1. This is the middle pivot here. This is the R2, okay? And again, support levels S1, S2, S3 are areas where buyers may step in, potentially causing price reversals to the upside. In other words, a bounce to the upside. Resistance levels, R1, R2, R3, are zones where sellers might enter the market, causing price reversals to the downside, or bouncing down, okay? Traders may use pivot points to help make trading decisions. For example, if the price approaches the first support level, S1, it may be viewed as a buying opportunity. Conversely, if it nears the first resistance level, R1, it might be a suitable time to consider selling. Okay, so these are bounces from these levels, right?